You want to know what are the best stocks to buy now? I've got 5 stocks that I think are attractive at these levels and, of course, lower. Let's go. Before we get started, big news tomorrow: FOMC and the Fed with interest rate cuts. As of right now on Tuesday, traders see the odds 63% for 50 basis point cut. That's a reduction in rates compared to 62% a day ago. The chances of 25 basis points is 37%. Of course, this could move markets, so keep that in mind. I'm going to provide 5 stocks that I think are attractive at these levels, and if we have a sell the news event, even better. In Fired Up Wealth, one of our strengths, one of our focus areas is technology and trying to see what the future looks like to invest in those companies to maximize profits. One exciting area, of course, is robotics. Now, with Tesla, optimists could be big, and Tesla should be on your radar. That's not the stock pick today. Let me give you some background of why this next pick could be huge in a few years. When you think of the 20th century and factories, what have we had to rely on? Workers, manual labor. But now, automation is in full swing, and we're just getting started. Elon Musk, on a Tesla earnings call, said it's possible for the company to sell $1 trillion of humanoid robots annually, and that Tesla could reach an unbelievable market value of $25 trillion. Bruh. This is what we call a moonshot and could be huge for Tesla down the road, as well as autonomous vehicles, robotaxis. Now listen to this. Cathie Wood at Ark Invest believes that humanoid robots represent a $24 trillion revenue opportunity. And it's not just Cathie Wood and Elon Musk that are convinced about the potential future for humanoid robots. Big investment banks like Morgan Stanley are also on board. The analyst Adam Jonas believes that these robots could bring about cost savings of roughly $500K to $1 million per human worker over 20 years. And this is just a fraction of what these humanoid robots would cost, anywhere between $10,000 to $30,000 to manufacture. Now that is impressive ROI. Morgan Stanley also believes that by 2030, we're talking about 6 years from now, America could have as many as 40,000 humanoid robots helping humans. So Tesla could be a huge beneficiary, but what's another company that's really obvious, that sticks out like a sore thumb? Well, Amazon employed about 1.5 million people globally as of June of 2024. Now think about this for a second. If 1 million plus of these workers are in factories, and if you replace just a fraction of those people, what does the cost savings look like for Amazon? And Amazon's already an exciting company because of AWS, cloud services, AI. It's now an advertising titan as well. These gross profit margins are 48%, and these actually were lower if you look back a couple years ago. But I believe that these profit margins can improve dramatically with robotics in the warehouses. So Amazon's the first stock pick. It's not the cheapest right now, but if I'm thinking long-term investment, 3, 5, 10 years, this is one of those companies I have high conviction in that it's going to be worth more when I need the money down the road. Let's talk about another Fired Up Wealth favorite, a high conviction stock. You know the drama about CrowdStrike and the global outage. The stock has been on a decline since the company triggered a global outage of IT system that caused much of the world's most important infrastructure to shut down. The hatred online, social media was very strong, even for the CEO George Kurtz on platforms like X. The exact financial damage is yet unknown. The last earnings report was solid, and they addressed this issue and did a very good job of doing so. Now, this article says that some government intervention might be necessary if the damages reach a level that threatens the existence of CrowdStrike. This is saying that CrowdStrike is essentially too big to fail. It's that important of a company. It is the global leader when you think of endpoint cybersecurity. But as you can see on your screen, it's doing so much more than that now, with $100 billion of TAM, total addressable market. This is suggesting that the government might have to invest money similar to how they did so with the CHIPS Act with semiconductors, and that CrowdStrike would be a major beneficiary. The stock right now is down about 30% from all-time highs, and of course, the global demand for cybersecurity is only going to increase with time. The big question I have, and something I've pointed out on live streams in our private community several times, what happens when quantum computing becomes more of a thing? If a country like, say, North Korea gets their hands on quantum computers, what does that look like for a company like CrowdStrike? And can it successfully pivot? You probably know that CrowdStrike is part of the S&P 500. So this is a high quality company, especially when you look at the cloud SaaS universe. It has cash and cash equivalents on hand around $3.7 billion according to a quick search. Because it's SaaS, software as a service with recurring revenues, it does run high profit margins. This gross profit margin TTM on Seeking Alpha over 75%. And the growth in this is solid, roughly 30% a quarter. Now, evaluation is where it's going to get tricky for a company like CrowdStrike. A value investor might look at a forward PE, a gap PE ratio, and it might be something like 500 and say, this is absolutely ridiculous. I'm not going to touch it with a 10-foot pole. And that might be true because it might be a risk tolerance. You might not have an understanding of the sector. This has never been a cheap stock, even being down 30% from its all-time highs. Previous coverage from Fired Up Wealth for CrowdStrike, we've suggested $150 or less DCA. My cost basis is around $100 a share, and I've been long since 2019, shortly after the IPO. If you're in the private community, you know that the preference was around that $200 a share level when it sold off recently. My thoughts are to dollar cost average into CrowdStrike on any weakness. But I believe that CrowdStrike is a great long-term investment, 5 or more years, and with all these stocks, guys, DCA, dollar cost average. Up next, let's mix it up with a more speculative type name. This is the only stock of the 5 or really 6 stocks I talked about today that I don't currently own. So when we talk about spec stocks, of course, understand the risk. We always say 10x or 0. Now, this stock is nearly free cash flow positive, and it could be a great long-term winner. This company has over 900 stores across the western and southwestern portion of the United States. Dutch Bros has doubled its store count and tripled its sales since 2020. Despite that rapid growth since 2020, roughly 3/4 of its 918 stores reside in only 5 states: Texas, Arizona, California, Oregon, and Washington. And furthermore, it only has a presence in 18 states across the United States. Management believes that store count can reach more than 4,000 stores over the long term. And as I mentioned in the intro, it's nearly positive free cash flow. Here's a chart showing the numbers. You can see the progression. Because this is a retail brick and mortar type of company, it's going to have lower gross profit margins. This is part of the reason I don't own the stock currently, about 26.5%. So the profitability grade on Seeking Alpha is a D, but the growth grade is an A. And you can see some really strong numbers across the board, including forward revenue growth around 26%. But that operating free cash flow year over year is up almost 120%. It's not a cheap stock, and there's speculation that it's going to grow and that it's going to grow into its valuation over time, similar to like a Wingstop. It's an expensive stock. It's hard to justify the valuation. This is running about 104. This is a gap forward PE ratio. And the price to sales, the forward is around a 3.14. So if Dutch Bros has a pullback and any weakness in the market, it could be an opportunity to snatch up some shares. I hardly ever watch this show anymore. I happened to be in the kitchen. I was making some food. I was cooking food for the family, enchiladas and tacos, just in case you're interested. And I just happened to turn on CNBC, and Jim Cramer was on Mad Money. And right as I tuned in, the CEO of Broadcom joined in an interview. Now, Hock Tan is somewhat of a legend, especially in the semiconductor space. And yes, fellas, you heard correctly. I said Hock Tan, not Hock Tua. If you're not familiar with Broadcom, it really has traditionally been more of a semiconductor company, but over the past 5, 6, 7 years, started to get more and more into software infrastructure. Now, Broadcom is focused on enterprise, and I think that's important to understand. Some companies focus heavily on B2C and have a mixture of both, where Broadcom is primarily focused working with those enterprises. And especially in the AI space, when you think of AI fabric, Broadcom really is the leader. So phase 1 infrastructure next to companies like Nvidia, helping build out those servers, those data centers, connect those different data centers to build out those LLM infrastructures. So I really like Broadcom because it's diversified not only in semiconductors, but also in software, especially with the acquisition of CA Tech. And of course, most recently with VMware and getting more into cloud services as well. And on the last earnings, I think this stock was priced to perfection. There's a lot of talk right now about slowdowns within semiconductors, and I think it's really important for you to listen to this clip from the CEO with Cramer.
Because this stuff is really dependent upon you. They can't just go. It's not a commodity what you're doing. But the idea that it could be slowing seemed to be completely fanciful.
Far from it, actually. As I said, this is a very focused and it's a long-term, it's a mid-term plan. 3 to 5 years I consider mid-term, but it could be long-term. We see that roadmap over the next, for these hyperscalers, over the next 3 to 5 years. And their intention is to build out these large clusters because what is needed to drive those large language models, those foundation models owned by these hyperscalers into improvements, to higher performance, into what they call higher IQ of their models, seriously, over the next 5 years, is to keep coming out with a new generation. Each new generation of LLM requires multiple X, 2, 3X, maybe more, of compute each time, each year. So you can imagine that's a driver towards a larger and larger compute opportunity, which is going to be taken up largely by XPUs.
I'm so glad you put it that way. So many people are saying one and done. That's the false narrative. The narrative you just laid out is the one that's going to keep Broadcom going. Now,
Broadcom is one of those high quality, high conviction stocks. I've owned it for many years. It pays you a nice dividend, just under 1.5%. Another stock that I'd be buying on any weakness. Last but not least, another high quality, high conviction name. Now, Broadcom, we just covered, owned that stock since 2018. It's done very well for the portfolio. It's been a beast. The yield on cost is amazing, as well as this next stock, which I've owned since 2017. And another dividend payer. Another semiconductor name here, Lam Research. So the business is all about providing equipment that performs specific tasks in the semiconductor fabrication process. So semiconductor equipment. And Lam is focused primarily on deposition, etching, and cleaning. For all of these other semiconductor companies to do their thing, from ASML to Taiwan Semiconductor and more, Lam Research is needed. What's really awesome about Lam Research, it also has a recurring revenue model. If you dig into the company, one of my high quality, high conviction stocks. I've got a top 25 high conviction stock list. Both Broadcom and Lam Research are on that list. And if you're interested in seeing that list, there's a Patreon exclusive you can go check out, patreon.com/firedupwealth. If you're new here, make sure you smash that subscribe button, the like button, drop me a comment. Have a great rest of your day. Take care.